This week and for the foreseeable future, it's Repo Madness. We'll pay full price. We'll overpay. We've already done $300 billion worth of really dumb deals for toxic asset garbage. So come on down to the Federal Reserve pawn shop, bank. No questions asked. We'll always overpay. We'll always pay full price or higher. No questions asked. Full money back guarantee. We're always going to bail out.
Okay, so I think that got my point across with another little commercial there about Repo Madness. $300 billion of repos, of emergency liquidity injections in only 4 days. And the announcements that the repos will continue, although it seems that the amount of repos today is down a little bit. So there's been a lot of interesting things the last week or so. It's been even crazier than normal. You had the craziness with the oil, with the Saudi oil production and refining facilities in Abqaiq. And then on top of that, you had the repos start. There's even rumors, and thank you to Scott, longtime loyal podcast listener Scott, the hat tip, for sending me this, copies and screenshots of, in Chinese social media, how there are rumors that the Chinese banks, the People's Bank of China, has even figured out how to get access to the repos. They may have even pledged their treasuries as collateral to get more emergency liquidity into the Chinese banking system because they need dollars. So that's the newest rumor going around Chinese social media. Thank you again to Scott. Just the new normal, guys. Crazier and crazier, more craziness. Things are accelerating. The new normal I thought was pretty bad, but apparently it can continue to get even crazier. So, on top of this, Jerome Powell just did a press conference this week, and he was talking about how sooner than later the Fed will have to resume balance sheet growth. So there's a link to the article if you want to read it, summarizing the speech. And he says, quote, "Going forward, we're going to be very closely monitoring market developments and assessing their implications for the appropriate level of reserves," Powell said at a news conference. "And we're going to be assessing the question of when it will be appropriate to resume the organic growth of our balance sheet." And by organic growth, he means bullshit. He means time to restart QE, time to expand the balance sheet. So I wanted to, more than just the lame excuses that the talking heads on mainstream financial media, the professional money managers who make 6 or 7 figures per year and are routinely wrong, and who said that the repo injections, emergency liquidity repo injections in 2007 and 2008 that were $300 billion, $350 billion, $400 billion, up to $450 billion per month were only temporary, and that the large banks back then would buy back all the toxic asset garbage, that the Fed was only lending on good collateral. In actuality, we found out that the Fed was not lending on good collateral, that the Fed was buying back at full price instead of 10 cents on the dollar, or at zero, probably more likely zero, some of these derivatives and other toxic garbage like collateralized mortgage obligations, collateralized debt obligations, mortgage-backed securities, and other garbage that the Fed bought starting in the repo market before, which preceded QE. That almost none of that was repurchased. But the talking heads in the mainstream financial media, the professional money managers making enormous, grossly overpaid off the status quo, told us that it was only temporary. And I suspect that the Federal Reserve now, if you take a look at their balance sheet, it is up to, according to the St. Louis Federal Reserve website, it was updated yesterday, $3.844695 trillion. So it actually bottomed. The balance sheet got as low as, let me get the exact number here, I think it was on Wednesday, August 28th. This is the lowest it looks like it's gotten, $3.759946 trillion. That was the absolute lowest we are going to get officially. So if you take that number and you divide that by the total amount of the official Federal Reserve balance sheet, that the QE programs and all the other reinvestments from the interest rates on the treasuries into expanding the balance sheet, that it got around $4.5 trillion. The Fed was only able to reduce their balance sheet officially by 16.44%. That is it. So that was all the Fed was able to reduce their balance sheet by. And we're looking like, with the press conference and other hints and clues. Goldman Sachs and other people are now putting out research reports that they expect the Fed not only to accelerate permanent open market operations, which would probably be larger amounts of these repos, repurchase agreements or repos available for banks for emergency liquidity, but the increasing likelihood of quantitative easing restarting in November. So there's a number of articles here, if you want to read them, about laying out how the Fed will most likely be increasing the balance sheet by at least $180 billion per year. It's almost definitely going to be on the low estimate there, and they're predicting that QE could restart officially as early as November. But the balance sheet on the St. Louis Fed's own website has already started to increase again. It is up from $3.759 trillion at the end of August to $3.844 trillion here in mid-September. Crazy stuff, guys. And why would the Fed restart QE? There are three main reasons, in my opinion. So, number one, the dollar is too strong. We're in a competitive devaluation, beggar thy neighbor, race to debase. So you have the regular dollar index, which is holding up at 98.962. So the dollar index has still stayed above 98, shockingly, despite these comments from the Fed, despite the rate cut that the Fed did earlier this week, although that was priced in. So the dollar index is still strong. On top of that, the trade-weighted dollar index, it has corrected a little bit. It is at 130.6571 as of September 16th, but the St. Louis Fed tends to only update it about once a week. Yeah, so it was as high, the trade-weighted dollar index, which hurts emerging markets in China the most, was as high as 131.5789, excuse me. So it looks like there's a little mini correction on there. So you have a combination of a dollar too strong, and Trump and the U.S. Treasury does not want that. They're trying to competitively devalue. Trump wants to do the mercantilist playbook, and boost exports. On top of that, they want to pay back the debt and pay back entitlements in lower real terms. And devaluing the currency allows the governments to pay back their debts or obligations in lower real terms. So you have the people in power wanting a weaker dollar. On top of that, you also have how the banks, the large U.S. banks, have a lot of garbage. They have additional now toxic asset garbage that may not be worth even 10 cents on the dollar at this point. These collateralized loan obligations, which are the new derivatives doomsday machine. They were very, very small amounts. And now they're backed by junk bonds that are so bad, that have no debt covenants, little or no debt covenants. Some of them no debt covenants at all. Some of these companies that were given corporate bonds and capital for junk bonds for debt, they are so bad that they have no rating, that the ratings agencies literally just make up a rating and chop it up and put it into this toxic sausage and then rate it AAA. Just like subprime mortgage-backed securities were rated AAA at one point before a lot of them went to zero. So the banks could be selling the Fed, the pawn shop, with this repurchase agreements, the amount of repo. The Fed could be buying back the CLOs now. We do not know. This is the problem with central banking. There is no real transparency. This is intentional. What we need is transparency if you want to know the truth. We would need a full audit to know which banks were selling what garbage, how much of it, and what the Fed was buying, and what they were overpaying for it. But I very seriously doubt we're going to get that, because there's a lot of reasons for that. Number one, the people would be outraged. Pitchforks. Torches and pitchforks. And number two, if we found out which banks were actually tapping the repo lines, the emergency liquidity repo lines, those massive amounts, if we found out which banks were actually tapping those repo lines, those banks would become under attack by short sellers, and those banks that drew the most on the repo would be in the most trouble and potentially could be bankrupt or insolvent within months, if not weeks. Crazy stuff, guys. Absolutely crazy. Oh, and the third reason, so I said dollar is too strong, policy mistakes from 1920s and 30s, beggar thy neighbor, competitive devaluation. Number 2 was banks, a few large banks may have way too much toxic assets on their balance sheet, and the Fed is helping them out by overpaying for the assets that may be worth 0 or 10 cents on the dollar or something and giving them full price for it. You know, basically a really dumb pawn shop owner. Because there's no way a lot of this stuff, if that is what is being bought, the repo agreements, with the repo agreements, the emergency liquidity injections, then there's no way the banks are going to repurchase that. Because the repurchase agreements that happened in 2007 and 8, almost none of the assets were bought back. And the third reason, I have to think about this, I think I just forgot it. I think it's related to the trade war. Oh, it's Treasury market, excuse me. Yeah, I just remembered. Sorry, I haven't had enough caffeine yet. I am not drunk. I'm not an alcoholic. Whoever said that is totally full of shit. It's the treasury. It's the amount of treasuries. So there's people that are anti-U.S., that are China apologists, and they're saying that all of this for the repo agreements has to do with treasury markets, that there's no demand. I don't think so. But the Fed will have to step in at some point, and they are selling a lot of mortgage-backed securities, and they are starting to rebuy treasuries. I think that's why the balance sheet is expanding, because they're starting to soak up more treasuries. It's not a massive amount yet, but there is so much treasury debt that needs to be sold going forward that the Fed may have to be one of the buyers. The banks, the large U.S. banks that are primary dealers, also are obligated to purchase that stuff. Yeah, the Chinese debt to GDP is 300%. And the Chinese household debt has exploded. There's a bunch of articles about that. So the 40% savings rate in China is no longer true. 10 years ago it was for households. So do you think that QE will restart in November? Rick says, Jason, some channels allow for a pre-announcement of a live show like 1 hour ahead of time. It just depends on my mood, and I literally get suggestions all the time, dozens and dozens of them that conflict each other. I get dozens of emails per day that it's my time. It's just impossible to respond to them all. So I cannot accommodate everyone for every suggestion, and I cannot respond to every single email now. If I did, if I responded to every single email, and I just wouldn't be able to get any work done. There's just too many of them. Any evidence at all these repos are not treasury backed? Stephen asked. That is an excellent question. No, Stephen, there's no way to prove one way or another, unfortunately. And this is why we need more transparency. There's no audits. And there's a reason why there's no audits. Because the Fed does not want the American people to know, and we found this out from the Ron Paul one-time partial audit and other information that came out. Remember when Goldman Sachs was testifying before Congress, people there, about their fraud and corruption with selling mortgage-backed securities and other stocks that were garbage. It's intentionally not transparent. There should be transparency. I'm for that, but I don't think it's going to happen. China walked away from the farm tour. That's interesting. Crazy Ant says he was going to mention what I just said. He thinks this repo madness is a way to get China hooked on more US dollar denominated debt. No, China actually announced, Ant, that they can't handle any more dollar denominated debt. They said as a policy in the last month or two that they will not allow any more dollar denominated debt. And that is why China has gone to the derivatives trading. That's why they're selling a ungodly amount of forward dollar swaps, and it has increased like crazy since 2015 and 2016 when China's total reserves officially dropped by a full $1 trillion in only 12 months. So China had $4 trillion in reserves in 2015. In about a 12-month span, it dropped by $1 trillion in 2016. And that's when the derivatives position exploded. And I hear the derivatives, one person, David Jansen, who's a friend of mine I speak to, he thinks, his educated guess, is that China has over $1 trillion in these derivatives, the forward dollar swaps. So no, I don't think China can't take Chinese companies, Chinese banks, no more dollar denominated debt. They've said it as a policy. Is Repo Madness QE by another name? Yes. Yes, but the people in the mainstream media, the mainstream financial media, and the Wall Street professionals will argue with you on that. People like Mark Chandler, who hates libertarians and is a big government apologist, and is always arguing with Peter Schiff, and I think he was like screaming at Peter Schiff in 2006-07 and even during 2008. And he was adamant back then, if I remember correctly, because it was a long time ago, and I've been following his work kind of as a contrarian indicator, that he was adamant back then that the repos, the repurchase agreements, were only temporary and that the banks could buy them back, and that was not QE. But yes, the banks, it depends what the banks hold. So if the rumors are true and Chinese banks did figure out a way to get to the Fed discount window and the overnight repo market, but I don't think Chinese banks have many subsidiaries here in the US. So normally the way the European banks got access to the extra liquidity, emergency liquidity stuff in 2007 and 8 and 9, 2007, 2008, 2009, was they had American subsidiaries besides the big currency swap bailout globally that we found out with a one-time partial, Ron Paul one-time partial audit, the Government Accountability Office audit in 2011, that many people on Wall Street and many people in the alternative media and gold community deny actually happened. I still get emails, I still get nasty messages from people that audit never happened. Tons of denial. People with best-selling books deny it happened. Audit deniers. What are my thoughts on oil? Well, just my opinion, not financial advice. Before the Saudi news, oil was in a bear market. That was getting worse. And the shale companies were close to bankruptcy. Some of them were very, very close to bankruptcy. So unless something materially changes, and we're getting a lot of news stories out about the global economy just getting worse, I would say that the oil bear market will continue. There may be some rallies. Again, not financial advice, just my opinion. If you do short oil or short oil stocks or short oil ETFs, I would, again, just my opinion, I would hedge. You can hedge this with a couple calls. You can hedge this. So if you short things, you buy puts, you can also hedge it with some calls in case there's another oil refinery that blows up, or another, whether it's a false flag or not, something that spikes oil. You don't want to be that hedge fund manager. I just saw this story headline on Zero Hedge before I started the show. You don't want to be the hedge fund manager that loses $300 million of your customer and your own money in about 2 days because you were heavily short oil and you didn't hedge your trades out. Look, I know a lot of smart people who have done extensive research, fundamental research, technical analysis too, and then used options for leverage to short. And almost all of them that had their short trades get screwed up, almost all of them, and I've asked them, why do you think you screwed up this trade? Oh, I was too early. Oh, I didn't expect these couple things, one or two things to happen. And almost all of them I asked, so did you hedge your short trade? And almost every single one of them over the years, and I've asked a lot of these financial professionals these questions, they're like, nope, didn't hedge. I was 100% confident, overconfident, I would say hubris, that things would play out exactly the way they thought in the exact amount of time, and they did not protect themselves with insurance on the possibility that they could have screwed up the timing or been wrong for the time period that they set their trades. Okay, that's just my opinion, just some analysis, not financial advice. Shorting is extremely dangerous. A lot of financial professionals lose a lot of money shorting. That's why guys like Jim Chanos and the guy from Bronte Capital, John Hempton, I think it's his name, or Hempson from Australia. That's why they don't concentrate their shorting positions massively. So they don't have only 5 shorts or 7 shorts or 10 shorts or 20 shorts. I think they have more than that. I think most of in their shorting portfolios, I think like most of their short trades are 5% of the portfolio or less. Again, just my opinion, just telling you how other successful shorts like Jim Chanos and some of the other successful ones have failed a lot too, and how they protect themselves. No, we're not at martial law stage, guys. We're not there yet. Most of the people are not woken up. Most of the people are still blaming capitalism. We're not woken up yet. Hey, thank you for the super chat, Dan. I appreciate it. D. Moore sends a super chat. Thank you for the $10. Negative interest rate bonds are a bailout. Your pension 401k is funding this. We would be up in arms if we bailed out the banks. This is just a billion tiny bailouts in a different format. Yeah, I agree. So the negative yielding debt, the negative interest rates, it actually doesn't help the banks. It only helps the overly indebted governments and also the overly indebted corporations. So the banks are actually getting killed because the banks, if you look at their margins, the banks' margins are contracting. Even Jamie Dimon admitted recently that he thinks that bank profit margins have peaked, that that was it over the last couple quarters. Ryan asks a good question. No reserve currency is ever hyperinflated. What does that mean? The dollar has to lose world reserve currency status to something like SDR for it to hyperinflate and gold to skyrocket? No. The dollar doesn't have to hyperinflate for gold to skyrocket. I think a lot of damage, guys, can be done just with worse stagflation. We already have bad stagflation now. I mean, things can get a lot worse, though. So we can go, if you look at the Chapwood Inflation Index, the real inflation rates on a lot of food, energy, consumer items, and healthcare, and the normal everyday bills that people have to pay in major U.S. cities and metro areas, the real inflation rate is 8 to 13% per year. I think in the Silicon Valley, San Francisco, San Jose area, it's about 13.2%, which was the highest. And it's between 8% to 13.2% per year on a 5-year average inflation. And that's just absolutely horrible because almost no one's income is growing that quickly to offset that type of real inflation. Now, we could go a lot worse than 8% to 13.2% per year. We can get up to, 16 to 23%. 25% in that range, 16 to 25. And if you're at 25%, man, that means because it's the rule 72 for doubling. They teach you this if you're a stockbroker. You have to take a test. It's one of the questions. So you take the number 25% inflation rate and you divide 72 by 25. So in less than 3 years, your prices would double. Your standard of living would be cut in half in less than 3 years if we get up to a real 25% inflation rate. And that will start to really collapse the real economy, society. You don't need hyperinflation. You only need worse stagflation will do the trick. Interest rates on credit cards going up too. So people's bills are going up for the everyday things that they need to survive. The portion sizes, for food at grocery stores, restaurants, consumer staple sizes are going down with shrinkflation. And then you add in new taxes layered on. And you get a large, it doesn't even have to be hyperinflation. It only has to be worse stagflation. Eventually people, even the talking heads on mainstream financial media and the financial professionals will eventually start to notice that they're paying, maybe it goes up from $20 for a good sit-down hamburger to 40 or 50. in less than a decade. And then it goes up to $80 or $100 for a halfway decent steak. And then maybe the mainstream financial media and the talking heads, the professional money managers, the mainstream guys will actually notice. But some of these guys, like Jim Rogers says, they have butlers. So they just pay their bill. They don't really care. They're making that much money. Guys, if we have 25% inflation per year would not be hyperinflation. It would just be really, really bad stagflation. And then your credit card interest rates would go up. And you would get lower purchasing power from your currency. You would have less portions for food and consumer staples. 25% inflation would destabilize. 25% inflation per year would destabilize society in the U.S. Because I would say a lot of Americans are not resilient. A lot of Americans are spoiled and entitled. And then capitalism would get blamed. And unfortunately, I hope I'm wrong about this, but I think government would get more control over the economy. You could see mistakes similar to what Diocletian did. Even President Nixon knew the history about wage and price controls. Remember, if you go back and look up what President Richard Nixon says, he was fully aware of how Diocletian put wage and price controls in the Roman Empire to try to stop a hyperinflation and currency debasement, and they didn't work. And then guess what? President Richard Nixon did them anyway. He tried putting in wage and price controls, and that just made the stagflation worse, right? No, Michael asked if 25% inflation would trigger hyperinflation. No. 25% inflation per year is really bad inflation. It's stagflation. That's not hyperinflation. The definition for hyperinflation is if the currency is going up just insane amount of percents per month. And then you're getting, I think the official definition of hyperinflation now that Professor Steve Henke said is the currency has to increase, the inflation rate has to increase in the currency by over 100%. It might be over 200% per year. Wow, more people in the comments section accusing me of being an alcoholic. Good job. I have 2 beers in like 2.5, 3 months on 2 different live stream shows. I had 1 beer each, and I admitted I had a beer, and then people are accusing me of being an alcoholic. Wow. Should definitely not have even a single beer anymore on a live stream show. Just ridiculous. One guy's like, I'm not trying to be rude. That's the exact same BS when someone says no offense and then insults you. DJ Georgie Porgy, actually you're wrong. It's socialism for the rich because the rich don't have to deal with losses. It's not capitalism for the rich. It's socialism for the rich because the rich have their profits privatized and their losses are socialized. Their losses are socialized by the governments, the central banks, and the taxpayers and people's purchasing power. Guys, if the Fed restarts QE 5 to 7 years from now, maybe sooner, depending on how things go, even without money, velocity of money, depending upon how much QE they do and how much the dollar devalues, we could have 25% inflation per year. I could see the Chapwood Inflation Index just massively ramping up, another 50% easily. Not immediately, but over a course of like a few years. It just depends how much QE is done and how quickly. Look, bro, if you're going to thumbs down the podcast, fine. I don't care. I have enough people who respect my work now. I have almost 150 Patreon account contributors. I've taken 1 day off in the last 4 or 5 months, providing you guys with the best analysis and content possible. Been busting my butt to grow this channel. YouTube has censored things lately in the last 3 weeks or a month. I was growing at 2,000 new subscribers per month. It almost went down to 0 in the last couple weeks. I think I added 100 new subscribers in the last 3 or 4 weeks. That's how much the censorship has increased. And then here you are in the chat section. You went out of your way to try to insult me. Thanks, Michael. I'm glad you like it. You know what's funny? People just say, like, no offense, I'm not trying to insult you, and then they insult you. Okay, guys, well, I think I got most of the stuff covered that I wanted to get covered. Let me take a look at the articles to see if I got everything. There's quite a few articles here if you want to read this more in depth about predictions for when QE is going to restart in November and how initially there's going to be about 180 billion. It says per year. Let me see if I can find the article. I think last time. Okay, so liquidity scramble, Goldman Sachs research report, the strategy for now for permanent open market operations. Goldman Sachs is assuming a roughly 15 billion per month rate of permanent open market operations for now, bond purchases. Enough to support trend growth of the balance sheet plus some additional padding over the first 2 years to increase the size of the balance sheet by 150 billion. In the process, restoring the reserve buffer and eliminating the current need for temporary open market operations. The strategy would result in balance sheet growth of roughly 180 billion a year and net U.S. Treasury purchases by the Fed, the sum of the red and gray bars in this chart in the article, of roughly 375 billion a year over the next couple of years. Interesting. I think that's probably on the low end. So, 3 main reasons that the Fed would restart QE sooner than later. Number 1, competitive devaluation, beggar thy neighbor, race to debase, lower the dollar is too strong. The trade-weighted dollar index is a problem right now for China and emerging markets. Number 2, it's to take toxic assets off the bank balance sheets. This garbage like collateralized loan obligations, which in my opinion seem to be the worst of the worst. There's at least 600 billion directly of CLOs, and there may be a lot more derivatives attached to it. The stuff inside the CLOs is really, really bad. There's stuff so bad that it should not even be assigned a rating at all. It's such bad junk with no debt covenants that it should not be even assigned a rating, and the ratings agencies are actually assigning it double C. That's how bad this toxic junk garbage is, and the Fed will, at some point, in my opinion, have to pay full price for this garbage that is probably worth zero. And there's at least 600 billion of it, maybe more, directly, and then we don't know the amount of derivatives that are attached to that as well, to the CLOs. And then the other one is Treasury purchases, because the U.S. is running enormous budget deficits. Trump is instituting supply-side economic policy with the U.S.'s debt to GDP ratio conservatively measured at already over 100%. And supply-side economics, it only does not really work. Ronald Reagan was able to do it and bankrupt the Soviet Union, but only because the U.S.'s debt to GDP ratio had been taken down a lot before Reagan was elected for his 2 terms. And I believe when Reagan took office in his first term, the U.S.'s debt to GDP ratio was only around 30%. And then he took it to 50% in 8 years. So he did a lot. He was running big budget deficits. It did help bankrupt the Soviet Union, though, with the spending. So at the time, there was a legitimate threat for that. But what government should have done, guys... Oh, thank you for hitting the like button. I appreciate it. If you don't have money for Super Chat tips or to become a Patreon contributor, monthly PayPal contributor, I think I have about a dozen of those now. You can just hit the like button. That's fine. What government should have done, and it's not going to happen, it seems, because starting with George W. Bush and then Obama, now Trump, there's almost little or no total cuts in federal government spending. And you're at a situation now where interest on the national debt is high, entitlement spending for the federal government is high, and it's a third rail to cut entitlements massively. Look at the state level where the entitlements for pension funds and the states are just having enormous difficulty reducing their obligations for pension funds. I don't know if I want to go on Real Vision because they want me to do work for them, a lot of work for them from what it sounds like, for free. And as big as their YouTube channel is, I don't want to be working for free anymore. I make some money here doing this. If I was making no money, I probably would have quit a while ago. So if I can make a living doing this, which I'm eking out a living now and providing you guys with good content, some of the best analysis for free. It would be nice if I got a paid advertiser, it would help things out. But I mean, so many of the bullion dealers I've spoken to are so unethical, guys. Like literally, I've had signed contracts where the contract was signed, it was negotiated, it was signed, and then it was sent to the headquarters of a gold company. You would know the company. I've talked about it. It's Gold Money. And they have a copy of a contract, and then they just ignored enforcing the contract. They did absolutely nothing on their end. So they have a copy of a signed contract up in Toronto that took months of work to get done, and then they just decided they didn't want to. They just basically told me to pound sand after that. Real ethical, real moral stuff. Compared to them, I'm the little guy. I don't have $1 billion in assets under management. I don't have my shares on the Toronto Stock Exchange. I don't give out stock options to people writing articles. Kevin asks a super chat question. I'll wrap it up after this. Getting tired. And then maybe I'll do another live stream later today. We'll see. Just wanted to get this out there. Go and re-listen to the funny little commercial I did at the beginning after the stream is over. I think it's pretty funny. Although the last couple seconds of the recording didn't turn out well. I did some editing to it, and I think I screwed up on the editing with Audacity. I make currency. Come on, guys. It's just a figure of speech. Kevin asks, will QE work again to kick the can? It depends. It depends. I think, Kevin, I think the U.S. is being saved for last. I think Kyle Bass is right. So initially, here's the funny thing, guys. Initially, when I started studying what Kyle Bass was saying in his analysis a number of years ago, about 5 or 6 years ago, I didn't agree with a lot of what Kyle Bass said. I didn't agree with a lot of what Kyle Bass said. Kyle Bass was saying that the U.S. would be saved for last. And he was warning people about China and some of the other problems. And at that time, 5 or 6 years ago, I still believed a lot of the stuff coming out from the gold community about China, that the U.S. was going to collapse first, and a lot of the other things. And then a lot of the predictions that Kyle Bass made started coming true with the problems in China and some of the other things. He's not right on everything. I don't agree with him on everything. I don't agree with anyone on everything. But he said for a while now, for at least 5 or 6 years, that the U.S. would be safe for last, and that the U.S. was being given, probably stupidly, more rope to hang itself with. So there's so many, in a roundabout way now, long answer, not the short answer, to answer your live chat question, your super chat question in the live chat. What I would say is that in the next 2 or 3 years, probably, I don't even know if we have that, but something big will break. Whether that's corporate bonds here in the U.S., or European banks, or emerging markets, or China. Those seem to me to be the most suspect problems, the largest economic landmines. And then, once something breaks, Kevin, that's when you're going to get the chain reaction of other things breaking, of central banks attempting to step in. If you read Jim Rickards' new book, Aftermath, Jim Rickards talks about this, where he spoke with Timothy Geithner. And Geithner did not like Jim Rickards' SDR suggestion. He said it was bullshit. And Geithner says that the central banks will just guarantee everything. So he says that the central banks, like the Federal Reserve, the European Central Bank, the Bank of Japan, the People's Bank of China, so the largest central banks, the Bank of England, the Reserve Bank of Australia, the Canadian Central Bank, what they will just do is everything will be guaranteed. So all bank accounts will be guaranteed, all stock brokerages will be guaranteed, and Geithner thinks, that will make the crisis not as bad. No, Kyle Bass is not CIA. Jim Rickards has CIA security clearance. It's disclosed in his books. Kyle Bass is not CIA. Kyle Bass is a money manager who made a lot of money shorting subprime mortgages and mortgage-backed securities in 2008. So once something big breaks, then whatever that something is, then it will set off a chain reaction. I'll give you a hypothetical example. So if China has immense problems and with their derivatives now, their forward dollar swaps, and the European banks are the counterparties on the forward dollar swaps with the Chinese banks, and the People's Bank of China and Chinese government ordered the forward dollar swaps, and the position is in the trillions. We don't know the exact number. David Jansen says it's 1 trillion. I think it's probably higher, but we'll see. So if China has problems and their dollar-denominated debt problems increase, and China can't pay dollar-denominated debt, and China decides to stop paying back some creditors or counterparties, and guess what? Some of those counterparties are European banks. Well, that's going to exacerbate, make worse, the problems for the European banks. So that would be an example of one economic landmine going off and then triggering another large one. Do you see? Or European banks going collapsing first, and then the Federal Reserve has to step in and actually publicly announce that they have trillions or unlimited currency swap lines to the ECB. That would be another problem. Or the corporate bond market with the CLOs, collateralized loan obligations, blowing up. That could take down an insurance company or 2 or 3 fairly quickly. No, Alex has given me money on Super Chat. I don't have a problem with Alex. I think it's not wise to attack Kyle Bass's credibility. I mean, the man, go look up his life story. He came from poverty, from poor parents, and he worked his butt off to get into college, get a scholarship. It's just ridiculous how people are attacking. The man's a billionaire. He's not right on every trade. He's made mistakes like everyone. His mistakes are just all publicized. When he goes on TV for an interview on the mainstream financial media, they only like talking about his mistakes. If he's a billionaire, he has more winners than losers. It's just ridiculous to accuse someone like that. He's not right on everything. He's made trades against governments like the Japanese government with Japanese government bonds and shorting the yen. It has not worked. Okay, guys, well, thank you for your time. Hopefully you learned a lot from this short little show, and everyone have a great weekend. We'll see if there's another show coming up later today. There probably will be one tomorrow. Okay, but definitely, if you're not getting notifications, and I hear a lot of people are not getting notifications from YouTube, check back on the channel every day or two to see if there's new content. Okay, guys, bye for now.